So today we'll revise economy notes that I have prepared from my coaching institute. This will be a short session. So let's start. I will also share some of the facts while I am reading the notes so that you and I both can recall them. So let's start. Okay, so what I have revised just now is basically capital expenditure, revenue expenditure, capital receipts, and revenue receipts. So revenue receipts is basically the government is getting money, but as it is not a capital receipt, so generally when we say the term capital, it is of long term. It can create an asset or a liability. But when you say revenue expenditure, so it is sorry when you say revenue receipt, it is only something that the government is getting, let's say from interest payouts. So that is basically your revenue expenditure. When you revenue receipt, then when you call about capital receipt, so this can create liability on the government, right? So this is long term thing which can create liability, and so this is your basically capital receipt. Then revenue expenditure, again, like because it is revenue expenditure, it is not a capital expenditure, so it is not going to uh, create a, let's say asset for the government, right? So it is going to be something that is only for taking out the day-to-day activities like paying of salaries, then paying of pensions and all, right? So this is basically the revenue expenditure. Capital expenditure is used for building out, let's say, the infrastructure, right? Which can, let's say, give job opportunities to youth, right? So this is basically your capital expenditure. Within revenue expenditure, also there is two type of expenditure. One is developmental revenue expenditure, and second is non-developmental revenue expenditure. Developmental revenue expenditure is like, let's say, hospital services are there, so making them better, like spending on making them better, or educational services are there, spending on making them better. So this is basically your developmental revenue expenditure, right? Non-developmental revenue expenditure is again the thing that I was referring previously, that is paying of salaries, paying of pensions. So this is not doing any kind of development, or let's say different services and all, although they are very critical and they are very important, but it's not creating any development as such, right? So this is basically your day-to-day activities that we just have to take care, which don't really create any development. Like let's say subsidies. So subsidies are given to some people, some people who are not able to let's say afford things, like ration shops are there, or let's say minimum support price is there. So this is a non-developmental uh, revenue expenditure, right? So the expenditure is being done, it's not creating asset, um, right? It's not creating asset, and it's not doing a direct development as well. So that is a non-developmental revenue expenditure. Okay, so let's revise what I read just now. So I read about the classification of taxes. First is the classification between direct and indirect tax. So let's first talk about direct tax. So direct tax is basically it's a lump sum amount, right? And it is, let's say you have heard about income taxes, and also income tax is basically one of the direct taxes. And so let's say someone is getting paid more, so he pays more of the tax. Someone who is getting paid less, he pays less of the tax. Or sometimes the tax is there is zero tax as well if it's below a particular tax bracket. So if you see, this is a progressive kind of tax, because here you pay according to how much you earn, right? Then let's talk about indirect tax. So indirect tax is basically you pay after uh, purchase of some product. So let's say it is GST, right? So, and one special thing about indirect tax is that even the richest of the rich or poorest of the poor pay the same amount of tax. So it is called as the regressive tax. So direct tax was progressive tax because it is equitable, more equitable as compared to the indirect tax. The thing about direct tax is that people feel burdened about the direct tax because it is paid once in lump sum amount. For indirect tax, people don't feel that much burden, and also awareness is not there much. So sometimes what happens is if the revenue is less, then the government increases the indirect tax because people really. So it's because people lack the awareness about the indirect tax, and it becomes slightly easier for the government to collect the indirect tax. Right. Now, yeah. So this was about the indirect taxes. Uh, Now coming to, so then again there are two terms here. One is ad valorem tax, that is ad valorem. It means it is added to the value of the product. So let's say the value of the product is rupees 100. So there is some tax that you have to pay above that rupees 100, which is dependent on the price. So let's say if it is some taxes, let's say 18%. So it's so instead of paying rupees 100, you'll pay rupees 118. So that is your ad valorem tax. Then the second type of tax is basically what you can call as specific unit tax. So what happens here is how much units you buy, not on the price of that unit, but based on the unit that you buy. Like let's say you buy five, then you pay five times the more tax, right? So this is basically your specific tax or per unit tax. So windfall tax is one of these examples, right? So what happens is sometimes if let's say the oil prices rise drastically, then what happens is some of the companies profit a lot. So on per barrel basis, the government can collect that okay, this much barrel you pay this much tax because you are getting so much inflated profit, so you pay this windfall tax. Right. So this was about the windfall tax. And I think I have kind of summarized everything that were. Yeah, also let's talk about two terms. One is tax evasion and one is tax avoidance. So if you think evasion term is more worse, and it feels more of a crime than tax avoidance, right? So just to relate with the terms, so tax evasion is where you hide the tax itself, hide your income itself. So you show a very less income, so you are basically doing, so whenever you are hiding your income, you are doing tax evasion. Tax avoidance is that you show that much income, whatever you have, but you use some loopholes in the system to pay lesser tax. So this is basically your tax avoidance, right? Yeah, I think we have covered most of it. Mm, So one more thing. So indirect tax, as I was saying, so it is, let's say you buy some product and you pay on top of it. So it's not only for goods, but it's for services also. So you would have seen that in even in educational services, you need to pay some tax, right? That is basically your service or goods tax, right? GST, or services tax. Hmm. And again, one more thing is that you are paying the indirect tax only when you are consuming that particular goods or service. So that is obviously the thing that differs direct tax and indirect tax. Right. So I think that should be it regarding this topic. Next, what I'm going to read is I'm going to read about different type of taxes further. So this was a broad classification, direct tax and indirect tax, but within them there are sub classifications. So there is personal income tax, there is corporate tax, there is minimum alternate tax, right? Capital gains tax, service securities transaction tax, right? Then there is TDS, tax deducted at source. Then there is TCS, tax collected at source, right? So these are the different types of taxes. So let's read them now. Okay. So there are seven total such taxes that you need to go. So I was reading personal income tax. So when there was this, so when there is when people use this old tax regime, they can get exemption if they, let's say, invest in yeah, life insurance schemes, or let's say pension funds, life insurance schemes, pension funds, and then there is this ELSS as well, medical policies and all. So this is another IT Act 1961 ATC. So let us read slightly about this on the internet. I'll just go chat GPT about this. Okay, so ELSS is basically your equity linked savings scheme. Equity linked savings scheme. Let's remember that. So it is equity linked means it is stock market linked. So it is basically you invest in mutual funds. So and there is a locking period of 3 years for availing this particular scheme. So within ATC section of the Income Tax Act 1961, you can so this is basically a bucket, right? So in this bucket there are multiple things that you can do. Either you can do a 5 years FD, or you, let's say you are taking some home loan, or you are paying your children's tuition fees, right? Then there is this ELSS as well there. So right, so within this you can, let's say, invest rupees 1.5 lakhs, right? So then what happens is your total taxable income, let's say if it is X currently, it becomes X minus 1.5 lakhs. So the income tax will be basically computed on this taxable income instead of your original income, right? So as the taxable income is getting less, so you are going to pay lesser tax, right? So this is under ATC section. Then you can also invest in the NPS scheme of the government, that is pension scheme of the government. In that you can put in rupees 50,000. So if you put in 50,000 rupees in NPS as well, so your total taxable income can become, let's say it was X previously, it will become X minus 2 lakhs. So in total at max you can reduce your taxable income by rupees 2 lakhs from your original income. So this was basically the thing that you could do with the old tax regime, right? But with the new tax regime, you don't have all of these tax saving tools. But at the same time, so if let's say but if you see the salary bracket for this, so that is slightly increased. So what happens here is, in older tax regime, if you earn between 5 to 10 lakhs, you pay 20% of the tax, right? But here in the newer tax regime, if let's say you earn between 6 lakhs to 9 lakhs, it's basically 10%. The 9 lakh to 12 lakhs, it's 15%. So in this tax bracket, so the amount of tax has itself reduced. So generally people who pay who actually earn more, they generally prefer this new tax regime, because in old tax regime, as I said, the max reduction in the taxable income can be at max rupees 2 lakhs. So that is your personal income tax. Yeah, so I think first part we have covered, that is personal income tax is covered. Within that we have studied old tax regime and new tax regime. We have also seen what are the ATC things that you can claim. Within that we also get to know about equity linked savings scheme, which is basically based on how good the stock market perform, that much appreciation you might see in the amount you invested there as well. So that is one thing. So you are going to get some returns on the in mutual funds investment. At the same time, you are able to uh, show that as one of your investment, and that can reduce your taxable income. So right, that was about personal income tax. Yeah, I think we have covered most of it. IT Act, ATC also we have seen. Yeah, okay. So let's move ahead. So next tax that we are seeing is corporate taxes. Okay, so next thing that I have read is about corporate tax. So corporate tax, as the name suggests, so this is paid by the companies, and right. So, and the interesting thing is, it is paid on the profits of the company. So you would have seen that many of the founders are alleged that they show their company in losses just to avoid this particular tax. So the rate at which this tax is applied is basically, if it is an old company, then you pay more tax. So it is 22% of the tax of your profits that you pay if you are an older company. If you are a newer company, so you pay lesser tax because you have just started. So it's logical basically. So you have just started, so you pay 15% tax. Right? If it is an old company, you pay 22% tax. Right? Now what happens sometimes is, some of the companies, they shift their operations completely to such a nation which has lesser corporate tax, right? So this particular phenomenon is known as base erosion profit sharing, right? So what is base erosion profit sharing? So this is basically shifting of the companies from higher from the countries which take higher corporate tax to companies which take lesser corporate tax, right? But then there is something called as so there is a new principle in that is global minimum corporate tax. Okay, so this was suggested by OECD and G20. So what it says is that at least 15% of the tax should be taken. So it has set a minimum bar. So no, none of the countries can reduce it down further. So what happens is that this can help in avoiding the base erosion profit sharing. Correct. So the principle is one globe, one corporate tax. Right. So this is basically the principle that it incorporates. So this was about the corporate income tax. Let's revise it. It's 15% for the older companies, for the 15% for the newer companies, and 22% for the older companies, and this is on the profits. Right. And we also got to know about the term-based erosion profit sharing. Right. So let's move ahead. So next thing that we are looking at is minimum alternate tax. So let's read minimum alternate tax, and that should be it for today. So let's read this and complete. Right? Read this minimum alternate tax. What this is not written it down very clearly in my notes. Okay, so let's do this concept very quickly. So see, what happens is some of the companies also, if so, there is concept here. So basically, what we discussed previously was 22% of the tax is paid by the older companies, right, on their profits. But sometimes they, so this bracket of 20% becomes 22% becomes 30% if the company is showing some exemptions under the income tax act. Okay, so then what happens is the corporate income tax becomes basically 30% instead of 20% because the company is itself showing some exemptions. Let's say the total profit, the book profit earned by the company was rupees x, Then if let's say it has shown exemption of rupees y, so the corporate income tax will basically become 30% of x minus y, right? Now what happens is, what minimum alternate tax is saying is that sometimes what happens is companies show so much exemptions that their total profit becomes zero or it becomes very less, right? So many of them escape from paying any of the taxes. So what minimum corporate tax does is that it says you will pay max of the following two quantities. First quantity is 15% of the book profit, that is profit without considering the exemptions, and second would be, so 30% based on your corporate income tax, so 30% of your uh, profit books minus the exemptions, right? So basically one is 30% of x minus y, and second is 15% of x, right? So whichever is the higher, you pay that much amount of tax. So what happens with this is that the companies which are using the exemptions and all to reduce down their profits, then so the tax applied on them will be 30% on the exempted amount versus the 15% on the book profit. Whichever is higher, that much they need to pay. So overall, they need to pay at least some of the tax, right? So this is what minimum alternate tax does, right? Yeah. So I think that should be it for today, right? So I think let's also see at what rate are we completing the pages. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So we read 9 pages today, 45 minutes. So it's about 5 minutes per page, which is fine. So that should wait for today's session. Thank you.